All right, so I recently covered a video breaking down how banks play on our ignorance by paying us fractions on our deposits while getting us to pay multiples on our debt. I want to take this concept a step further by breaking down the foundation to the interest rates banks use with our money. And that foundation comes from the Federal Reserve. I want to give you a breakdown on an entity that you probably heard a lot about since 2020 in particular, that is behind the decision making and the moves banks make, the rates banks set with our money, and how it really plays into the wealth gap and keeping a lot of us broke and making those who know how to play the game exceptionally rich. In order to do that, I want to give you some backdrop on how APY and APR works again. For those of you who maybe didn't catch the last video, still go back and watch it. But the short of it is essential. APY is basically going to be what you're paid on your deposits. So think checking, savings, and CDs. And this is going to be an annual percentage yield. It's the yield or return on your deposits over the course of a year. It is basically going to be a mathematical equation of the simple interest rate. So if they're paying you 2% on a simple interest rate on your money, and the APY is also calculating the accumulative growth of that money over a year. So your 2% maybe on a monthly basis is paid out. They're going to do the math on what that adds up to for the year. So the APY may turn out to be 2.02%, for instance. Hopefully that makes sense. So basically the APY is taking the simple interest rate and accounting for the compounding of that money for the year. APR is doing something a little different. It's taking the simple interest rate you're being charged for debt, credit cards, mortgages, auto loans, for instance, and it's taking the simple interest rate and accounting for all of the fees within a year's time, not the compounding. So the interesting thing, as I broke down in the previous video, is that for APY, you may be advertised a CD for 6 months that is giving you a really, really shiny APY, but you're not really getting that APY because at the end of the day, you only have that CD for 6 months. You're not reaching a year. So it's going to give you a bigger number than what you're actually going to earn. On the flip side of APR, it's not accounting for the compounding. So they may tell you that something is 10% in the APR in actuality, but you could be compounding way more than 10% by the time a year plays out on that money. So this is a breakdown on how banks use a finesse. Basically, even though they disclose to us the difference between interest rates and APY, they never really usually take the time to break it down, or your banker doesn't. That having been said, this game gets much deeper when you start talking about the Federal Reserve, because now you're talking about where banks get their money from, and the rate that they set is determined by the Federal Reserve. So you're basically going to the mothership, if you will, of interest rates. So when you start talking about the Federal Reserve, for those of you who may not be clear, the Federal Reserve is an independent body that works very closely with the government. They're not federal, technically, they don't hold reserves, and they don't offer technically really banking services. But what they do, they're an entity, an independent entity that works very closely with the government to control our monetary supply. And they do this to basically stabilize the economy. So say, that having been said, part of their function is to control the Fed's fund rate, or basically the market interest rate banks pay for the money that they use to eventually lend out to us. Hopefully that makes sense so far as well. Comment down below if you need a little clarity. So what that basically means is the Federal Reserve is where it starts. Then banks have to pay whatever the Federal Reserve is charging on their interest rates to get money to eventually put out in the marketplace to us as consumers and business owners. That having been said, when the Federal Reserve is trying to control the economy, they may change interest rates up or down based on the needs of the economy. For those of you who lived through 2020, which I presume is pretty much everybody, then you may have observed the Federal Reserve drop rates to stimulate the economy because we had a health crisis that shut the economy down. So what they did was make money more accessible, make it cheaper, so more of it can go into the economy, and there'd be more economic activity to make up for the fact that we weren't functioning in the economy. The other side of that equation, a couple years later, That money flowed into the system. The economy ran extremely hot. The stock market went through new highs. Real estate went through new highs. And the financial system was heating up and the economy was heating up so much, the Federal Reserve had to go on the other end of the spectrum and make rates higher, which made money more expensive and made it harder to get access to. That cooled the economy down. So say, that having been said, hopefully that makes sense. This is where the game gets deep. I want to show you something I'm going to put on the screen really quickly to illustrate a little bit more about what I'm talking about. So as you guys can see here, this is a random screenshot that I took of some a news report that came in on one of the websites that I follow. And as you can see, they are basically showing where the stock market, where Bitcoin, where gold and silver all landed towards the end of 2025, which is very impactful. S&P 500 rose 0.5% to surpass December 24 high at 69.32. The Dow dropped off based on what was going on with Venezuela. Bitcoin actually made a little bit of a recovery with a 3-week high. Gold surged to $4,500 per ounce, which is a significant high for 2025. Silver up $80 an ounce, which is a huge high for 2025 and an all-time high, nominally speaking. And the Federal Reserve, as you can see down here on the fourth bullet point, cut rates in December and have been cutting since September. So what does all of this mean? Let's actually get our financial literacy together with this and break this down and figure out what all of this actually means, because it does matter significantly. Let's get this off the screen for a second. So what that basically means is the asset and financial markets largely rose towards the end of 2025 and a good chunk of 2025. In the same time frame, the Federal Reserve was lowering rates. Now, that's not the only factor that affected the stock market, gold, or Bitcoin. Let's be clear. But it is absolutely a significant factor. And it goes back to the banking relationship that you have where your money is being fluctuated by these interest rates by the Federal Reserve, okay? Starting on the base level, the Federal Reserve moving rates up or down determines whether you get paid higher or lower on your deposits. It also determines if you get charged higher or lower on any debt that you take. So the Federal Reserve is the wholesaler. They put money out at a certain interest rate. Let's just say 3%. The banks get that money at a wholesale rate of 3%. When they get it, they put their spread on top of it. So their profit margin and for their operation, let's just say they take that 3 and they turn it into 5 or 6 or 7. That's what we get as the banks are the retailer and we're the consumer. So we get the back end retail price of that money. So if the Federal Reserve raises that rate from 3 to 3.5, the bank is going to charge you more on debt and pay you more on your deposits to stay competitive, because the rest of the rates are going up. So if they don't change the deposit rates, then you're less likely to keep your money with them. So they will increase what they're paying you on your deposits, but it's never going to keep up with what they're charging you on debt. So the Federal Reserve is the helm of this. They are the crux of how this charge is changing. Same thing when rates come down. When they come down, you get paid next to nothing on your savings or your CD, but you are getting charged less for your mortgage or your credit card rates, in theory. There's other moving parts to that, but this is impacted. It ripples out to those rates, okay? So let's put this in a broader context on how this impacts the wealth gap and how this starts to impact, those who come out rich and those of us that come out broke or poor. The financial markets also fluctuate by the Federal Reserve's rates. As I mentioned a little earlier, if the Federal Reserve wants things to heat up, then they'll start lowering rates and putting more money in the system. When there's more money in the system, because of that rate change, that means more money is chasing pretty much a similar amount of goods and services. This increases companies' valuations in the stock market. Why? Because they're the ones selling the goods and services. This increases real estate, for instance, because there's not an random increased supply of homes or real estate, but there's more money in the system buying it and pursuing it. Same thing goes for gold and silver. Because there's more money in the system, that means the value of the currency, the dollar in our case, is less. It's going down because there's more of it. So that means stuff like gold and silver is going up in its value or its nominal price, its number price, right? So the same thing can happen on the other side. When the Federal Reserve says the economy is too hot, things are getting out of control, the cost of things is going up too fast, they'll make money more expensive. This tends to slow down how much money gets put in the economy. Then that means there's less money chasing goods and services, less money going into real estate. Gold and silver may have its own impacts. Bitcoin fits into this conversation, even though it's a lot more volatile. It also is impacted by the same things. This is how the wealth game is played. So now for those of you who may be thinking back to 2020, if you're following me, that basically means that when the Federal Reserve lowered rates because of the health crisis that was going on, and real estate went through the roof, stocks went through the roof, Bitcoin went through the roof, that's because they pumped so much money in the system. Those who own stocks, own businesses, own real estate, own Bitcoin were made tremendously wealthier. Those of us that were paying for those things, paying for the goods, paying for the services, paying rent, paying for these various things, goods, services, and resources, etc., we took the L because those things started to cost more in nominal terms. We don't own these things, so we're not benefiting from all of the money flowing into it, but we're paying for it. So this is how the game of interest rates gets deep, because now at this point in time, when the Federal Reserve moves the level up and down, depending on what my money is going into and where it's sitting, I'm getting paid more or less on my deposits. I'm paying more or less for my debt. And if I don't own the right assets, I'm paying for goods and services that are increasing in costs, but I'm not benefiting from the growth of those assets and those financial markets. Does that make sense? This is the crux of the wealth gap in a mathematical and a financial term, in a financial concept and breakdown. This is really it. This is really the gap between rich and poor. The Federal Reserve in the interest rate and the mathematical side of things is the one controlling that. Banks are the ones right behind them retailing that out. And so this is why it is exceptionally important for us to have financial literacy and have an understanding on how this works. Because let me give you a theory on how you can flip this on its head. Now, instead of you blindly leaving your money in a dry savings account or a low-paying CD or a checking account, you leave just enough to maintain a healthy banking relationship. Now maybe you deploy your money in stocks, or you deploy it in real estate, buying a home or buying rental property. Maybe you buy some cryptocurrency or some gold and silver. Now you take that same money and you put it in assets and financial markets that are growing way faster than the average interest rate at the bank is. You see how this is how the game is played. This is the difference between being a tenant renting property and the cost of that property going up and that rent going up with it and the cost of goods and services driving up the price, versus being a landlord where you may have taken out debt to buy that rental property, but at the end of the day, you're always going to be able to pass the cost of that debt on to the renter while earning a profit still, a higher interest rate of return than the interest rates again that you would be getting paid in the bank, or that you might be suffering from with debt. As long as this is why debt isn't universally evil per se. It's bad in a way. It is an obligation to another entity. So technically it's always bad in a way. But if you can get that debt to get you an asset that's going to get you a return higher than the cost of the debt, you're winning. And this is the entire name of the game in the banking and financial system. When I finally get my hands on money, am I going to be a fool and blindly sit it in the bank and get paid next to nothing while I'm turning around and spending and borrowing at higher rates? Or am I going to park just enough money in the bank to navigate my banking relationship on a healthy level, have an emergency fund if necessary, but deploy the rest of this money into financial markets and assets that will continue to grow every time rates go down or the monetary supply grows or inflation picks up? Because inflation is just a word that surmises the cost of goods and services increasing or the cost of energy picking up, etc. So this is why it is exceptionally important to turn words into wealth. This is how we turn words into wealth, because now we understand when I go and sit down at the bank and I open a bank account, this is how far that really goes. Every decision I make at the bank, this is how far it goes, because the bank is where you're gonna deposit, spend, and borrow. The three functions your money will ever have, the bank is where it's gonna all happen at. So me optimizing my money, as I'm looking to teach you, the optimization of my money sitting at how I navigate my banking relationship and where I park my money. So banks, as long as you don't understand that, banks are going to continue to pay you pennies on your deposits and make it look all fluffy on the advertisement, while making it look nice and easy going on the side that you're paying on the debt, while raping you on the back end. Excuse my terminology, but that's basically what it is. Because they're going to be charging you way more than what the rate you're going to get quoted. Because it's compounding, but the APR doesn't account for compounding. Your APY accounts for compounding, but you may not be earning that APY if that's not how long your money's parked there. Not to mention that deposit rate is always going to be lower than inflation most of the times. It's always going to be lower than what you're going to pay in debt. The only time your money's going to actually out-earn debt and out-earn inflation is when it's in assets and when it's in the financial markets, period. That's it. Assets can include a business, by the way. Real estate, business, stocks, crypto, gold, silver. These are going to be the places your money needs to be parked if you want to be on the right side of the interest rate game. Otherwise, you're going to be on the wrong side of the interest rate game, because the money you're earning is going to earn next to nothing. And you're going to always be spending and paying more for your spending. And you're always going to be paying more for your debt. Hopefully that makes sense. Comment down below, because this is genuinely one of the most powerful videos that I could shoot on this channel of the nearly 1,000 that are on this channel. This is the crux of the wealth gap in a mathematical sense. Interest rates. So comment down below and let me know what you learned and how this has impacted your perspective on banking and your money, because it should be next to everything. Comment down below and let me know your thoughts. Let me know your ads. Let me know, your rebuttals, your questions. Comment down below, because you definitely should have something to say after this video. I want you to also get in the description section down below where you can tie in with me on Instagram. I'm putting out different content there that will also continue to expand your financial literacy and help you continue to turn words into wealth. So you can stop looking at these disclosures, thick stacks of disclosures at your bank, not knowing what the hell you're looking at. Meanwhile, they're basically giving you a broken down tree telling you that we're about to completely pillage you and your money. Not because banks are inherently evil, but because you don't know any better and you're not moving with your money appropriately to benefit from the banking system versus being a victim to it. So comment down below, time with me on Instagram in the description section. Like, comment, share, subscribe, support the channel so the channel can clearly continue to support you. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.